Don't wait until retirement to implement tax-effective retirement strategies. The benefits of most tax strategies begin before retirement, not after, and I'll show you why. In this video, we'll take a look at 8 tax-efficient strategies for your retirement. Some of these strategies can easily reduce your taxes by thousands of dollars each year. Plus, if you stay until the end, I'm going to give you the answer to the most commonly asked super tax question that I get. Are super earnings tax-free after age 60? Hey there, I'm Chris Strano, the founder of Super Guide, your #1 resource for planning retirement. I'm also managing partner of the retirement planning firm, Toro Wealth. This is general information only and does not constitute financial advice, so please read the disclaimer found in the description below. I hope you enjoy this video and subscribe. Okay, #1, salary sacrifice. Salary sacrificing into super means that you arrange with your employer to have a portion of your wage paid directly into your super fund instead of into your bank account. And the benefit of doing this is that it reduces tax in 2 ways. Firstly, the tax on salary sacrifice contributions into super is only 15% compared to being taxed at your personal name at up to 45%. So salary sacrificing $10,000, for example, in 1 year could reduce your tax by $3,000. Which is the 30% difference between the marginal tax rate and the contributions tax rate. The second tax benefit of salary sacrificing is that once the contributions are paid into your super account, it'll be invested and generating investment returns. And these investment returns within super are taxed at a maximum of 15%, compared to being taxed in your personal name, where again, it could be taxed at up to 45%. So as you can see, salary sacrificing into super in the lead up to retirement can be a very beneficial strategy. In fact, many people will often be maximizing their salary sacrifice in their final working years. So what you should be doing right now is figuring out the amount that you can salary sacrifice into super based on the maximum cap amount plus any available unused amounts carried forward from previous years. I've done a full video on how much can you salary sacrifice into super that you might find helpful. The link is in the description. Also, if you'd like to read more about salary sacrificing or any other strategies mentioned in this video, I've provided a link to each one below. Okay, the #2 tax strategy for retirement is personal deductible contributions. Personal deductible contributions are contributions that you make into your super account and claim a personal tax deduction for it. So deductible contributions essentially have the same outcome as salary sacrifice contributions because they reduce your personal taxable income so that you pay less tax. But personal concessional contributions are more suitable if you are a self-employed person or a sole trader, whereas salary sacrifice contributions are used by employees who receive a wage. Again, as you approach retirement, you should be looking to maximize your personal concessional contributions into super by finding out your cap amount and any unused carry forward cap amounts from previous years, and then get as much as you can in, provided that it's affordable and beneficial to do so. The main downside of contributing to super is that you can't access the funds until retirement, but obviously the closer that you get to retirement, the less of a downside that this becomes. Okay, #3, this is my favorite, a transition to retirement strategy. Once you reach age 60, a TTR strategy enables you to reduce your personal income tax without reducing your after-tax income. In fact, in most cases, you'll be increasing your income and super balance at the same time as reducing your tax. It's an excellent strategy that doesn't always get used to its full potential and can cost you tens of thousands of dollars in tax each year that you don't use it. The way that this strategy works is that you salary sacrifice part of your wage into superannuation, or you can make personal concessional contributions if you're self-employed. Now, making contributions into super is obviously going to reduce your take-home pay, but you still need to eat. So it's no good saving tax by contributing to super if you can't pay the bills. So what you do is you commence a transition to retirement pension, which pays you tax-free income. Now you have the money you need to cover your living expenses, but you've done it in a smarter way because you're basically swapping taxable wages for tax-free TTR pension income. This strategy or variations of it are often beneficial and can be implemented every single year from age 60 until retirement. I have previously made a video on this exact TTR strategy and the link is in the description. All right, #4 on the list is the trustee account-based pension. An account-based pension is an income stream that you start with your super once you are eligible to do so. You simply transfer your super balance from an accumulation account into a pension account, which provides you with regular income. An account-based pension is the ultimate tax planning strategy for retirees because it not only provides you with tax-free retirement income, but it also ensures all investment earnings within your pension account are received completely tax-free. To start an account-based pension, you need to either be over age 65 or have satisfied the superannuation definition of retirement, which is being retired after reaching your superannuation preservation age with no intention of returning to work, or have had an employment arrangement come to an end after turning age 60. As soon as you are eligible to start an account-based pension, you should be considering it, even if you don't need the income, because you can just chuck it straight back into super as a contribution, but still benefit from the tax-free investment earnings. Speaking of benefits, hit that subscribe button so you don't miss any of my upcoming videos. Okay, number 5 is the CGT retirement exemption. The Small Business Capital Gains Tax Retirement Exemption allows you to disregard all or part of a capital gain that results from the sale of a business or business asset up to a lifetime cap of $500,000. And even better, this can apply after you've already applied the other CGT discounts, such as the general 50% CGT discount and the active asset reduction discount. For example, if you sell your business for $1 million after building it up from scratch, meaning that the capital gain is $1 million, and you've owned it for 12 months or more, you can apply the 50% general CGT discount. So now your assessable gain is $500,000. Your business also qualifies for the active asset reduction, so you apply another CGT discount of 50%. Now only $250,000 is assessed. Then you simply use $250,000 of the $500,000 small business retirement exemption to eliminate the remaining gain. And this $500,000 lifetime limit applies per person. So between two people, you could basically wipe out a $4 million capital gain resulting from the sale of a small business by using the CGT discounts available to you. If you're under age 55, the amount of the $500,000 that you are claiming under the CGT retirement exemption will need to be contributed to a superannuation account. And you'll need to tell your super fund that it's a CGT retirement exemption contribution. If you're over age 55, then there is no requirement for the disregarded CGT amount to be contributed to super, but it can be if you like. And you might decide to do this because it won't count towards the standard contribution caps, so it allows you to get more into super. There are obviously conditions that need to be met, so speak with your accountant to see if you might be eligible for this CGT concession. Moving on, number 6 is a recontribution strategy. Unless you've had a financial advisor, you might not have even heard about a recontribution strategy or know what it means or how it works. A recontribution strategy is a tax-effective superannuation withdrawal and contribution strategy designed to reduce potential tax that would be payable when you die. Another benefit is that it can protect against potential changes to the superannuation rules. What a recontribution strategy does is it converts taxable components into tax-free components by withdrawing the taxable components and recontributing them back in as a non-concessional contribution, which becomes tax-free components. By doing so, tax on your super paid to non-tax dependents when you die, such as an adult child, can be reduced or even eliminated. On top of that, a recontribution strategy can protect against potential changes to super rules that could result in super withdrawals for people over age 60 being taxed yet again. Most people will perform a recontribution strategy once they retire or reach age 65 when they have full access to their super, and it's usually done in the first few years of retirement in chunks of $110,000 or $330,000 due to the contribution limits. In theory, it's simple to implement. Withdraw $110,000 and recontribute it back in the next day into an accumulation account. However, there's a few little tricks to be mindful of to do with contribution caps, potential taxes inside super, timeframes, and ensuring that the tax components aren't contaminated once recontributed. Plus, because we're dealing with some big figures, you really don't want to stuff this up. My opinion, it's a worthwhile strategy, but get professional advice. Number 7 is the spouse contribution tax offset. The spouse contribution tax offset is a tax planning strategy that incentivizes one member of a couple to contribute into their partner's super account and provides you with a personal tax offset of up to $540 for doing so. To get the maximum offset, you simply contribute $3,000 to your spouse's super account. You then notify your super fund to let them know it was a spouse contribution, and then you mark it on your tax return. That's it. It's a guaranteed 18% return and you can do it every year. To be eligible for the full amount, your spouse needs to earn less than $37,000 per year, and then it scales down as their income gets closer to $40,000, where it caps out. This strategy becomes more prevalent as you get closer to retirement because sometimes a spouse will often reduce working hours in the lead up to retirement. There are some other eligibility requirements, and I've done a full video just on the spouse contribution tax offset, so check that one out. The link's in the description. Another tax benefit to be aware of, although not really a strategy, is the low income super tax offset. This one actually happens automatically. The low income super tax offset provides you with a tax offset of up to $500 each year if you are considered a low income earner. This isn't a personal tax offset, it's simply added back into your super balance automatically as an effective reimbursement of contributions tax. If you earn under $37,000 per year, then you may be eligible for the low income super tax offset. All you need to do is complete a tax return and ensure that your super fund has your tax file number. Alright, now as promised at the start of the video, I'm going to answer the most common question I get on a daily basis. Are super earnings tax-free after age 60? Despite what you might have heard, the answer is no. Just because you reach age 60, it doesn't mean that super earnings are received tax-free. Withdrawals from super are generally tax-free from 60 onwards, but your earnings on your super investments are only tax-free once you start an account-based pension. Earnings tax will remain payable on super earnings within an accumulation account or a TTR pension account, regardless of your age. That's it for tax strategies in retirement. I hope you enjoyed it. Make sure you like and subscribe. Until the next video, stay super.